Workers' compensation insurance in 2024 offered a compelling contrast to broader property and casualty market trends. While the total property and casualty industry bounced back into profitability, workers' comp quietly continued its long streak of strong underwriting performance, but with some notable shifts under the surface. Let's break it down. Workers' comp net written premium declined slightly from $43 billion in 2023 to $41.6 billion in 2024. This marks a 3.2% drop, driven primarily by declining rates and continued loss cost reductions across the market. For context, approved bureau loss costs decreased by 6.1% heading into 2025, evidence of ongoing rate softening in the voluntary market. Despite the premium contraction, the line maintained a strong net combined ratio of 86%, one of the best across all major commercial lines. That means insurers collected 86 cents in claims and expenses for every $1 of premium earned. That's incredibly efficient. Medical and indemnity severity both rose 6% in 2024. But here's the twist. When adjusted for rising wages, the year-over-year increase in total severity was just 1%. That signals stability, but also a key trend to watch. Utilization patterns, like more frequent physical therapy or imaging, are starting to place upward pressure on costs. Another factor, claim frequency. It continues its long-term decline, but the pace is slowing. Some indicators like mega claims, those over $10 million, remain rare, but they're not disappearing. In fact, 1 in every 28,900 claims crosses that threshold. Residual market activity remains stable, with the market share holding around 5% and total premiums in assigned risk pools staying flat. That shows most employers are still able to secure voluntary coverage, though access varies by industry and state. From a financial perspective, the line continues to benefit from strong reserve positions and solid investment income. NCCI estimates around $16 billion in reserve redundancy across the system. And, investment gains on insurance transactions remain solid, critical support given the declining premiums. Now, what about 2025 and beyond? Wage inflation is expected to slow. The combined impact of modest payroll growth and softer pricing could continue to pressure premium volume. NCCI is watching a few key developments. Whether claim frequency continues to flatten or reverse, the impact of systemic changes in healthcare, and any legislative or regulatory disruption at the state level. The outlook for workers' comp remains cautiously optimistic. The line is still a profit engine, but margin compression, rising medical costs, and wage-driven volatility mean insurers will need to stay agile. And if you're looking to break into insurance or explore a career in risk management or claims analytics, workers' comp remains one of the most actuarially and operationally rich areas to build deep industry expertise. If you enjoyed this video, don't forget to like, subscribe, and follow Insur Knowledge for more clear, concise insights into the world of P&C insurance. See you in the next video.